Hello, everyone, and good afternoon. Welcome to our next panel discussion, which will be shining a spotlight on capital markets. My name is Pawel. I'm a partner in the capital markets group at Shearman Sterling and a member of our FinTech Foundry program. Joining me today are four very distinguished panelists. Perhaps we'll start by me asking you to introduce yourself very briefly for the audience.
Sure, happy to go first. So I'm Charlotte Wood. I'm the head of innovation at Schroders Investment Management. So I look after mainly our FinTech engagement. So looking for opportunities for us to work with smaller players to accelerate what we're doing in-house. And I also work with our senior business leaders to help them understand what's going on in the market and where some of the emerging opportunities might be for us.
I'll step in then. This is Daniel Shepherd. I'm the CEO of Bton Financial. Bton Financial is an in-sourced dealing desk for investment and asset managers. We're a B2B SaaS fintech, and we help automate workflows on the sort of front office on the trading side for investment managers to achieve economies of scale and efficiencies in the market.
I'll continue. Hello, everyone. My name is Damien Fontany. I am in charge of business development at Tokeny for the French and UK markets. Tokeny is a fintech. We provide private market issuers with a SaaS platform in order for them to issue, manage, and transfer security token in a public blockchain. Our clients are corporate asset managers and banks. The company is based in Luxembourg since 2017 and operates globally. We are supported by Euronext as an investor and a business partner.
Hi, my name is Simone Bronenberger. I'm VP of Product at Eigen Technologies. We are a no-code AI or no-code document AI platform, which allows business users to unleash, I would say, the power of AI to review and analyze their documents. A large portion of our client base is in capital markets. So for example, we were working closely with Goldman Sachs, BlackRock, but also smaller funds like Fortress.
Excellent. Thank you very much. And thank you for joining us today. Just in terms of logistics, for people who are listening and watching us right now, I can see we now have more than 80 people joined. There's a Q&A button at the bottom of the page. Please feel free to ask questions as we go. We would like to make this session as interactive and as interesting as possible, and we'll try to answer all questions during the sessions. As I mentioned, we'll be talking today about FinTech and capital markets. Capital markets clearly have been going through a major transformation. And it's fair to say that today, FinTech-led innovation is not optional anymore, and is used across the entire value chain in capital markets. Access to capital, trade execution, post-trade services, data analytics, information services, operations and technology. We see FinTech everywhere. While the boundaries of technologies which FinTech companies use may blur, I would say that the solutions which are provided fall into four main categories: advanced analytics and artificial intelligence, distributed ledger technology, DLT and blockchain, cloud and quantum computing, and automation and robotics. Our panelists, as you just heard, are representatives of FinTechs that use each of those technologies. So without further ado, let's start. Let's talk maybe a little bit about markets and trends. So perhaps I can ask each of you briefly to tell us what you think is the current state of play in the capital markets technology, where you position yourself in that ecosystem as well.
Sure. So happy to start again. I'll pass on to each of these guys because they're all specializing in quite different areas. So I think from our perspective at Schroders, the FinTech space has come on enormously. I think FinTech used to be relatively consumer focused and relatively focused in sort of retail banking was where we saw a lot of activity. But over the last few years, that's definitely changed and extended into more specialized areas like capital markets. And we're seeing many more founders and senior leadership of these companies actually coming from capital market backgrounds with quite sophisticated understandings of the challenges facing the industry, and represented by our panelists here. So from our perspective, we're very optimistic about the promise of FinTech in this area. And I think something I would just add is that when we first started looking at technology solutions that could help us, a lot of them were more in the kind of, I guess, enterprise technology space. So they could be applied sort of across financial services or even in other industries. And we're definitely seeing solutions that are now much more tailored to particular niche capital markets problems, which is great for us because it just means much less customization is needed in order to work with these companies.
Yeah, I guess Bton Financial is one of those firms because we've all got a background in finance. So I've been working in finance for quite some years now, and so we can see the specific problems that need solving in the market. And obviously all this new technology that's coming to the fore now can really be a solution to a lot of these problems. So that's kind of where we've come in. So yeah, there is definitely disruption still occurring, and it's still really just beginning. Because again, to second Charlotte's point, there really, I think we saw a lot of moves already in some of the sort of the retail space with firms like Revolut who have kind of revolutionized a lot of stuff there. But now it's kind of moving up the value chain a lot more. So firms like Bton Financial, which are looking at sort of front office automation for investment managers, that's kind of that's right up there. So yeah, it's still in its early days, and markets are definitely changing. I mean, I could actually, as it's topical, I suppose we can see how much the market's changing because there's been quite a lot of chat this morning about a lot of these kind of Reddit chat rooms and so on. So I mean, it would be wrong to not mention that. I don't think we'll mention it too much because people can go into the news as much as they like. But certainly, yeah, things are changing. So we're definitely in flux, and there's lots of movement.
Yeah, I think just to build on what Charlotte mentioned around, I think particularly the point around customization. So we see as a document provider who focuses very much on the analysis and review of documentation, we see a lot of workflow transformation, but across front, mid, and back office, so really everyone in the organization. And I think all of these big tech buckets, be it AI, NLP, distributed ledger technology, cloud, they all focus on moving people closer to executing what their core skills are. So in our case, not reviewing 500 documents for the same data point all day long, or executing much more at speed. But what I find very interesting is that customization at scale point, because there's I think that especially holds true in capital markets, where every organization has a slightly different setup. For example, no CLO or CMBS team looks the same and operates the same. Everyone thinks that they have their proprietary way of looking at the market and analyzing that. And technology really needs to play to that and have like the flexibility to enable that. And so linked directly to that for me is something we haven't touched on yet, which is no code. So I think related to customization, there's a trend that technologies need to be no code. 3 years ago, everyone thought the future means everyone has to have a degree in artificial intelligence. Clearly, that's not scalable. That means it will take a long time to create any impactful application of the technology. So we see a move where we're actually providing AI to business users. So we empower business users to tell the technology what they want, but they don't have to worry about what they want, how that works. And that benefit is that subject matter experts, going back to my initial example, like CLO traders, portfolio managers, investment professionals, can really tell a platform like, for example, ours, what information they're after, but they don't need to worry about the how, about like how the technology will get there. And I think that really drives a lot of value. For me, that's the value multiplier in the industry, that subject matter experts can fuel AI themselves. I think that's, for me, one of the biggest trends.
Yes, on the security token side, and regarding Tokeny, we're seeing a wider market adoption for security tokens as a way to represent securities in order to digitize them, in order to facilitate issuance on the primary, facilitate also the secondary market for these securities. And not only corporates, but also financial institutions are looking to experiment the technology in all asset classes, be it equity, debt, or even fund shares. So that's very encouraging for us. All market participants are looking at it. Either they are issuing themselves. We've seen large corporates or even supranationals issuing bonds on public blockchains. But they are looking also at various verticals. You can look at securitization, you can look at funds, and you can look at many banking services that can leverage on security tokens that then represent any type of security. Tokeny, we have been selected to participate in a consortium of 3 banks last November in order to study the creation of an interbank digital currency that would be a key component in order to facilitate transfer of security tokens, in order to facilitate the DVP. Asset managers also are looking at our technology in order to increase operational efficiency and contribute to the digitizations of all their processes. So overall, market is maturing, wider adoption from institutionals and corporates. That's really the trend.
Yeah, and I think it's probably been really kind of sped up with this current situation that we've had over the past year, right? So that's probably brought things forward by anything between 3 and 5 years, where people are just onboarding this technology happier too, because they've all been, well, for this point in case, we're all sitting in various locations and everyone's now become used to that as part of their day-to-day business. So I think it's kind of sped up this trend as well.
Yeah, I think, Daniel, thanks for bringing that up. I think what we saw this year is COVID brought about, I think, a significant market dislocation. And what that means, at least in the document world, is that suddenly everybody is interested to understand what is in their document. What kind of covenants do they sit on in their credit agreements, because borrowers might default and they may have to restructure. So that really forced some of our clients to bring their budgets forward to apply or to actually bring in-house what we call smart technologies like document AI. But in that respect, I think COVID was a very positive accelerator for technology in the market.
Excellent, Simone. And as we go, we are receiving actually questions from the audience. Maybe one, which you, I guess, in part already answered from John. How do the panel feel that the current pandemic is accelerating digital adoption amongst capital markets fintech consumers? I guess you just answered, Simone, from your perspective, it is a major acceleration trend. Damien, Daniel, Charlotte, what's your view on this?
Yeah, it's coming fast, isn't it? So it's definitely sped up the process for sure.
I also think it will continue to speed it up, because everyone assumes that the economy, yes, it will bounce back to a certain degree, but we will live with, at least in the UK, with some depressed growth over the next couple of years, meaning there's a huge focus on cost cutting. And again, that plays into this automation theme that we're discussing here, right? So I actually expect that we will see more adoption of anything that can automate high value labor.
Yeah, absolutely. I agree. Oh, sorry, Damien, go ahead. Okay. I was just going to say, it's obviously had a big impact on us in terms of our digital client engagement as well, and having to make use of more digital channels to reach out to both our institutional and our intermediary clients. So that has been initially a challenge and a shift, but also there are a lot of opportunities that you get through that, because you can collect much more data through those channels. You can really help build your understanding of clients in a much more systematic way, which then can help you in terms of what products you're providing and the kind of content that you're providing to them as well, and really enable that tailored engagement. So if you think about personalized engagement with clients, that can only really be enabled through technology. So some of what's happened over the past year has actually probably accelerated our abilities in that space, as well as kind of forcing a change.
Yes, I was about to say that, Charlotte, effectively that the bank, as distributing financial products to retail investors, had to overcome this challenge of not being able to meet them physically, as used to be the case. And that's why digital channels for distribution of financial securities and financial products have increased tremendously. At Tokeny, we provide an onboarding platform in order for issuers to reach out to a wide number of potential investors in order to collect data and documents to make them eligible for the offering. And so a fully tailor-made subscription channel in order to receive investments.
Interesting. So I think we talked about a number of trends, right? So customization, personalization, no code, tokenization. One question from the audience, which I guess is in this category, from John Davis: does the panel feel that there are more of a greenfield opportunity for fintechs in capital markets, financial markets, than say elsewhere in financial services? Because historically there were less large mainstream tech players and tools being used.
So I guess I would say it sort of depends what area you're talking about, because technology isn't a new thing in the asset management and capital markets industry. There are some areas where technology players go back a number of years, and it's actually in some of those quite hard to displace the incumbents because they're such a core part of the infrastructure. But then there are areas that are much more greenfield, and I think client engagement being one of them. It has traditionally, in wealth and asset management, been a very kind of high touch, in-person sort of engagement. So thinking about using technology there is potentially more of a greenfield, but I think it really depends on which area is being targeted, because in some ways investment managers are huge users of technology and the data and the analytics that we use to make our investment decisions. That's not a new area. There's a lot of opportunity, but there are kind of existing companies to be displaced there, I would say.
Yeah, I guess from our perspective, there's lots of legacy software that's been around for quite some time. So we've had to, we tried to make ours completely, open access for ours, so we can you can use our front end, you can send us fixed message. We've been as flexible as possible in order to try and bring some of those systems together, really, including the data. So we're bringing in data, TCA, pushing that all through machine learning, but making it as accessible as possible. Yeah, but there's definitely we're not necessarily dealing with greenfield us personally, but there's definitely a lot of technology that can be updated and modernized, and processes that can be automated.
I think technology, at least in AI, is moving, or is becoming so cutting edge that it's actually opening new opportunities that we couldn't address in the past. So that legacy approaches, for example, couldn't even cover because of the sheer and pure data requirements. So if you think about unsupervised learning, if an institution like an asset manager needs to feed a software 1 million examples of an ISDA document and they only have 100,000, it's actually not even possible and feasible to approach that. So we deliberately tried to take the other end of the spectrum and took an approach where you really get away with an extremely small set of documents to create machine learning models, anywhere starting from 10 to 30 to create robust models. That opens up an entire new area in an institution, what I would refer to as the long tail end of low document volumes, but that are actually really valuable, like CLOs or CMBS investment documents that weren't accessible previously. So I think that would be greenfield for me, because it's just not there. No one is in that space right now.
Yes, I echo what you said, is that implementing a new technology is a challenge because you have to deal with legacy system, with players with licenses. So the approach we take with financial institutions is to define an experimentation that they can test the technology, how it could be integrated with legacy, and then expand further. With blockchain, we're dealing with infrastructure. Existing infrastructure has been there for decades. So we need to convince all the participants in the chain in order to do the switch to a new infrastructure. So this process takes some time. Everybody needs to get confident from an operational, legal, compliance standpoint that the new infrastructure brings the economic benefits, and also that it complies with everybody's requirements within the bank or the financial institution. So this bringing technology to existing business practices and regulatory frameworks takes some time.
Interesting. We have two more questions, or even more questions now. There are two questions about no code. Simone, I'm going to direct those to you, since you mentioned this point on no code. If you don't have to worry about how the technology gets there, doesn't that undermine explainability and hence trust? Who's liable if there is a mistake.
Yeah, okay, fair, very fair challenge, and an point taken. Definitely in the area of AI, there are two main challenges, right? One is the black box of artificial intelligence that everyone worries. If AI extracts information from documents and also delivers some interpretation, how do I know what actually has gone into that secret sauce? Can I really trust that decision is, I think, the fundamental question. I think there are ways to deal with that. So what we're doing, we're providing a very, very granular audit trail so everyone can retrace exactly what training material has gone into the machine and how has that been translated into decision making. Now that is something that our clients really appreciate, and it's going a long way to actually create that trust in the technology, because it's very traceable or auditable. I think these are techniques to work with. And then I think the other approach clearly that Damien mentioned earlier is that most technologies go through POC processes, proof of concepts, where through iteration and testing on more documents, you actually, and checking the results, you begin to trust the technology and then really understand that to a certain degree it's reliable. And the third, I think, big mechanism that you use is you try to combine humans with the technology. I call it sometimes human in the loop. I'm not sure if this is a negative connotation, but essentially what we have done is we've created a workflow where, first of all, the technology or the machine tells you very clearly as an end user if there's data where it is not very certain that it's found the right answer that you're looking for. So it really clearly asks for human direction for you to intervene and check these weak data points. But it also has a workflow that speeds that up and makes that quite scalable. So I think audit trail and actually keeping the human in the loop are, I think, two of the big mitigating aspects.
Yeah, I was just going to second that as well, because we can't do the black box AI either. We've definitely made it very clear that we need an audit trail for all of it, because it's trading directions. So people have to be very clear why the decision was made, and it has to be according to their best execution policy, and you have to document best execution. So it all needs to be very audit trailable.
Yeah.
So we've got.
I can maybe Simone, on your point, the interaction between artificial intelligence and humans, I can maybe offer my personal view and my personal experience. As I mentioned, I'm in the capital markets group, so of course we do a lot of what we do is going through documents as part of our due diligence process. So some time ago, we started working with one of the document review providers. One of the programs that goes into the VDR and just goes through all those documents in pretty much a few minutes, compared to a number of hours, which we need for our people, for our associates to do it. I remember I was quite skeptical at the very beginning. I mean, I think that's a natural reaction. We are all human beings, right? Whatever is new scares us a little bit. But one thing that I noticed very quickly was, in terms of, yes, the audit trail, and I think we all got comfortable with the quality of the software and so forth. But in terms of the end product, when I did a number of test runs, when I asked human beings to do the same review as my machine, surprisingly, oftentimes the result generated by the machine was better.
Yeah, we actually, this is really interesting, because we know we also do very large regulatory compliance exercises for banks where we churn through thousands of documents, and we are under a high scrutiny. So one bank experimented and took a couple thousand documents and had their in-house lawyers review that, four eyes of lawyers per document. And I think they came out at 80% or 90% accuracy, and the machine came out just around the same sort of level. And that was just that the other effort required 4 individuals to look at the same document, and the software got you right there. So we often approach this with an assumption that we as humans create 100% accurate results when we review, especially something repetitive. But I think we also need to be willing to challenge that assumption about ourselves.
Yeah, I fully agree with that. And this, of course, translates into, at least on my end, efficiency, but also costs, right? It all becomes much cheaper for eventually for the clients.
Yeah, I'd be interested to know what the time difference was between the 4 lawyers and the machine as well.
Obviously, the difference was, I don't know, it was probably 5 minutes for the machine compared to 2 weeks for humans, right? Exactly. So that's the difference. Simone, let's finish the no-code topic, because it looks like it's attracting quite a lot of attention, and we're getting many more questions. Before the financial crisis, people used to say that you don't have to understand the risk management techniques. You just look at the returns and go with it. Artificial intelligence is all very well until it goes wrong, so you need to understand it. You can't do that with no code. I think we addressed that in part already, but if you have anything else to add on this one.
Yeah, so I think you can make model governance, I think, also accessible to a non-technical user. So something like model evaluation that gives you a very sort of statistical and sophisticated way of assessing what the accuracy is in an automated way. That's something you can provide, I think, non-technical users with. Our models, obviously, we work with banks on regulatory compliance exercises, are under a lot of scrutiny, and they also need to be signed off by compliance. So I think this is actually, I think, a really important point, right? So how can you govern the models also over time? You need a framework for that, but we can make that accessible to non-technical users as well.
Yes, to echo Simone's point, transparency is key. On our side for tokenization, our smart contracts for the security token are publicly available. The code is available, so everybody can check for it. And we regularly perform with the external companies audits of them in order to give confidence to the clients that they are sound and they are fit for purpose. And of course, financial institutions will dig into the code to check for themselves. So important is really bringing transparency in order for clients to trust the solution.
Excellent. One more question. We talk a lot about the trends, and more recently how the COVID situation, the working from home, impacted us. There's one question from John. Do you think that the on-demand capacity provided by public cloud during the volatility of recent months has helped to change attitudes to new technology approaches generally? I think this one is for Daniel.
I was going to say, I'm not really sure actually, but I mean, we're all on the cloud already, so we'd already planned to do this. So we're all fully, in the cloud and access via VPN or obviously secure connection. So it makes it obviously everything. We're completely scalable. We have no volume constraints, and yes, it's you get the economies of scale benefits as well. So we can pass on those savings to our customers as well.
Yes, right. Same on Tokeny side. I mean, we rely on cloud computing. Our solutions are accessible either through interfaces we provide in white label format, so they can be fully customizable, or we provide the APIs for more sophisticated clients if they want to build a front end. So again, fully scalable.
Excellent. Let's move to the next category. So we talk a little bit about the market, the trends, what has happened recently over the past few years. Let's focus a little bit more on the risks and challenges. I have my questions, but surprisingly, we have actually many questions from the audience on this topic specifically. Some of them, Charlotte, are directed specifically to you. So why don't we start with those, and we'll then cover the others. Question for Charlotte. What are the top business challenges that Schroders is looking to solve with technology in 2021?
A few. I think we're at the point really where technology is going to be core to a lot of our business strategy. I think people are recognizing that now. I guess to choose a couple, one that I already, one that I already talked about was client engagement and the need for personalization in terms of the content that we're providing, as well as also thinking about the investment side and to what extent can we actually customize people's investments to a greater degree, and both of those are only going to be enabled by technology. So they're two big areas that we're looking at, and we'll need to partner. And I think the other one that is a big trend across asset management is ESG. So understanding what the ESG metrics are that you want to measure, how you're going to measure them, how you're going to access the data from different companies that help you to to give them a score on particular ESG metrics. All of that is a huge trend. It's really important to our clients. It's something that we've been investing into for years, and at its core really is a data challenge and an analytics challenge, and thinking about how you access the right sources of data and how you combine them to make something meaningful that we can then apply across our investment strategies. So I think that will only increase, and we really need to think about how we can make the tools that we've built internally to help our investment managers understand ESG and sustainability and impact, and how we can then make that available to our clients. So there are some of the large areas that we're looking at the moment.
Thank you. I think you answered in part the second question from Nicolas, which parts of technology within capital markets are you most excited about? So that's done. The second part of this question is for you, Charlotte. What is the biggest obstacle of large incumbents working with small fintechs in your experience?
I'm sure everyone on this call will have some thoughts to offer on this topic. So I think there are probably two. I mean, one is that there are hundreds of solutions out there that we recognize could help us, and that we could work with many companies and they would improve Schroders in some way. But I think it's about prioritizing which ones are going to be the highest value and the highest impact in both kind of the short term and also then longer term as our industry changes. So I think a big challenge that we face, and what my team try to help with, is filtering out kind of where our focus is best applied, because we do have limited kind of, as much as it's a lot of the effort is actually falling to the fintech, there is also a certain amount of SME input we need from within the business, and there's also the tech SME input. So it's the internal capacity, I think, is a really big challenge for us, and how we focus those on the areas that are most useful. One thing I'd also add, just on the risk point, is people ask me a lot about kind of what's the risk of working with these startups? Isn't there, doesn't that bring a lot of uncertainty? But actually, from my perspective, it's a lot less risky to partner with a company that has built a solution if you want to try something out than it is to try to build it yourself. Yeah. It's a much lower investment. They're clearly experts in the space, and you benefit from kind of a lot of expertise that they'll have from working with your peers as well. So I think it's more about a capacity problem than I think it is about a risk aversion.
Yeah, I mean, I can say we're finding that much more as well. I think firms were possibly reluctant a few years ago, and they'd be build it yourself rather than outsourcing anything. But firms are way more comfortable with the concept as a whole, really, and the collaboration benefits. And as Charlotte mentioned as well, you can just try it and see if it works for you, as opposed to having to allocate loads of resources to building something which you're not completely sure about. You get obviously the other benefits of the economies of scale. You only have to invest for a small part. And where everything's more SaaS orientated, you know exactly what your costs are, they're completely fixed. So it's really straightforward. And then other benefits are, from our perspective, where there's obviously the collaboration on the tech, but then we've kind of got the cool stuff going on with the data as well. So firms can benefit from collaborating on anonymized data from our perspective as well. So there's definitely more upside. Though, I mean, I won't lie that last year there was a lots of inertia or BCP situations where people didn't really necessarily want to change anything, but definitely there's been a lot of moves and plans made. Obviously, everyone went back in Q4 and put their budgets in place for the following year, and we're definitely seeing some big moves coming here at the moment anyway.
Really interesting, Charlotte, what you said, because if I think about our market, I think businesses or in capital markets is actually leading the way very often in adopting or being willing to work with new technologies and try them, because everyone recognizes smart technologies will help. What I find very interesting, that we often get the question, or there's a massive thought process that goes through, where do I apply it? How do I get value? How do I get started, right? Be it even what's the ideal way to demonstrate in a POC value of the bet, right? What's the area in the business? What subject matter expert can be involved? Or even more broader, how do I pick the right technology? So we get this question so often that we even put together an ebook on it. And I'm going to be quite cheeky and I'll share this link here in the chat, but I know that Innovate Finance will make that available in a follow-up email as well. So for me, it's not the willingness to work together. It's more the challenge of how do you get started and where, right? And that puts a huge burden on an organization, especially big asset managers, because there could be so many potential areas. So where do you get started first? So it'd be cool to get your thoughts on that, Charlotte, where to get started first.
Damian, anything on your experience with large
Yes, absolutely. I mean, collaboration and between financial institutions and FinTech is now an obligation for everybody. An obligation for financial institutions that don't have resources to build in-house. There are so many solutions out there, and as Charlotte pointed out, it's the challenge for them is to pick out the right partners to conduct experiments, proof of concept or MVPs, and then define the right use case, because you could have disconnect between innovation departments and businesses, and also dedicate internally the resources, legal, compliance, ops, front, middle, back office, all the partners to lead this experiment, because they are already busy with the existing business. And we ask these people to dedicate time and effort to experiment new technology. But what we're seeing across the board, there is a huge interest to test blockchain, to experiment security tokens, to see the value it can bring in terms of reduction of operational cost, in terms of potential speed, accuracy, enhanced distribution. So there are many aspects that can be touched upon. The issue here is to gather momentum within organization in order for each to participate and go to a concrete example with a limited time frame, with the right resources in order to reach a conclusion and potentially issue a security token.
Thank you, Damian. We have a somewhat related question from Miko. It's more a question for financial institutions and the bigger businesses that adopt the technology. What would your approach be to bringing a fintech, regtech company into a large financial services player, particularly thinking about relatively unknown startups? What are the typical steps of how you would make the case and establish trust, demonstrate success, and get the necessary buy-in?
Yeah, I can talk about how
Sure.
we try to work with companies. So I think this is the role that my team plays, is to take some of the burden off our internal teams who, as Damian says, have day jobs, and it's not necessarily part of their role to try and watch what is a rapidly evolving landscape. So we will often have an introductory conversation with a company to make sure that we think it's a good match for some of the challenges that we're seeing internally, and if we do see a fit there, we'll then introduce them as quickly as we can to the business area, because we don't find it very helpful to have a big gap between what we're working on and what the different business units are trying to do, because fundamentally if they don't want it, there's no point in us running a pilot or anything like that. So we do try to get them involved with the business as quickly as possible, which is really key. And then there's a conversation around what the product is. Would that meet a need? If it would, what would be the steps to kind of prove that value? And what's the kind of smallest effort way that we can try something out and see whether it actually would be firstly beneficial and secondly viable to kind of operating in our environment. I think there are some companies that need a little bit more support than others, depending on how many financial services clients they've had. Often it is, even if they're coming from other industries, if they haven't worked in our kind of highly regulated space before, that there are a few steps to take. So we do have an early stage startup program called Cobalt, which is specifically designed to sort of help support them in meeting some of the needs that we have, for example, InfoSec, compliance, legal. So we'll give a company mentors in any one of those areas as they need it. And we also give them access to the team that will be using their product. So they can come in, when we're back in the office, they can come in and sit with the team. They just have very close access so that they can make sure they're developing the features that would actually make it kind of workable within Schroders. So there's definitely a little bit that large organizations have to do to recognize, you know, it's hard to meet our needs when you're just doing it from the outside with guesswork. So the more you can tell somebody about what you're looking for and the requirements that they need to meet, the more likely you are to have a good partnership.
Damien, Daniel, and Simone, have you been? I'm assuming you've been working with bigger institutions as well, right? What was your experience?
So, clearly, I spent almost 20 years in capital markets, so I've been working on the other side, so I know how it feels like. So clearly, when approaching these large financial institutions, tech is one thing, but you need to identify what problem you're solving with tech. It's not going to be tech for tech's sake that's going to get you anywhere. You really have to identify the problem you're solving for them. Is it impactful? Does it respect the legal compliance, operational ways that your target is experiencing as well, in order for the client to identify clearly what is the value proposition? That's really would be my key message, is really have a laser-focused message on what problems you're trying to achieve and show an understanding of the constraints that the client is operating in.
Yeah, I mean, I could say that as well, because that's my experience as well, having worked, well, I came from a kind of very electronic trading background with the previous FinTech I had, which was kind of a latency sensitive connectivity and market data. And then I went and worked and was lucky enough to have a seat with London Stock Exchange, going around talking about the whole MiFID II solution that they provided. Which meant that I was going in to see multiple firms on a daily basis, and it was just very clear that it was the same problem and the same conversation kept coming up over and over again. So that's how I knew there was definitely a problem that could be solved with technology, and that's kind of why we started Bton Financial. So, but yeah, it's definitely hard to work with larger firms, and you're very small, so you do need to spend some time building up a track record with smaller firms and getting your name out there and being known, because no one's going to put all their trust in a company they've never heard of, for sure. So it's not worth the risk.
Yeah, I think just to build on Daniel's point, you really need to understand what pain point you're solving for and what value that brings to the end client. For example, NLP can be applied to a whole host of challenges with documents, but what problem do you actually solve? It's not the problem of extracting information, it's helping to execute trades faster or whatever it is. The other part, though, that we haven't spoken about is the burden to comply with, because it's a regulated industry, to comply with all the security requirements, right? So all the ISO certification, and I think we've accumulated 5 now over the years, and we're even a member of the Cloud Alliance, whatever it's called in the UK. For a very small startup, that's super costly, right? It's very, very expensive to meet all these high security requirements and have everything in place just to be able to cater to a large institution in financial services. So any help or flexibility that an organization like Schroders, for example, can offer through maybe sandboxes or a different way of running POCs is helpful.
Excellent. I'm just looking at the questions from the audience. Damien, there is one on blockchain technology, which I would like to direct to you, on the mentioning of blockchain, which are currently mainly utilized on the more back office functions, settlement, clearing process, or trading of illiquid instruments. What would you see as the pivotal event that would bring the same blockchain technology to be used more widely for liquid instrument, matching mechanism, and replace current major exchanges venues mechanism? That's a challenging one.
Yes, I mean, at the moment, blockchain is used for private market instruments that are not listed, so not traded publicly. That's the constraint that is imposed by regulation in most jurisdictions. So at the moment, we see the market growing in the terms of number of issuers and so on and so forth. The market is still in its infancy. I would say that once the technology has demonstrated its effectiveness on the private markets, which it is, then regulators can look at extending this to other type of instruments. So it's a step-by-step process where issuers, investors, regulator, professional bodies need to trust the technology. The second challenge is, of course, to agree on a standard, which should be which practitioners will establish. At the moment, you have competing protocols, you have competing blockchains. The landscape is evolving in a favorable way on our side. So it's a lengthy process, and this will take some time. So I don't think there will be a pivotal moment, or if there is, it will be when market leaders, financial institutions will decide to start with one protocol and one blockchain and decide to go for it for publicly traded instruments.
A somewhat related question, maybe for someone else. How feasible is the emergence of a Revolut for capital markets transactions, potentially servicing big tech companies with issuance models such as direct listings?
Again, maybe this goes back to the previous question and to what Damien was saying before, that we need to, rather than look at a solution to make, to try and fit something into a problem, maybe we need to solve the problems that are there first, but then with the technology, rather than looking for ways to find technology to fit into a space. I don't know, just that's a weak answer there.
I think it's the right answer. All right, those questions keep coming. All right, with so many players, where are the bottlenecks in FinTech adoption appearing? That's an interesting one.
I'll take this one.
That one is for you.
I think that comes to us again, and back to the challenges of working with these with FinTechs. I think the bottleneck ultimately, if they're B2B companies, often lies with the incumbent organizations like Schroders. So I'll put my hands up there and just say, we could partner with a lot of companies, but we can't partner with them all fundamentally. So it's about where our resources are most focused and where we kind of see the strategic opportunity and the value it's going to deliver. So our adoption will just be slower in the areas that we haven't decided to focus on, and that will be different for us versus sell side institutions, and even other asset managers will have different priorities. So I think it's up to the incumbents really, and where they choose to adopt the technology.
Yep. Thank you. Next question, this time for me. So we touched on different categories of risk, and David, you mentioned regulation. How do you view regulation? It is definitely something super important in your businesses. Charlotte, equally important to you, probably from a slightly different perspective. Just looking at the technology, do you view regulation? Do you view regulation as a driver, as an obstacle, or as a risk, or a combination of all of the above?
I mean, on our side, we see this as a clear driver for growth, in the sense that issuers and investors need clarity with the legal framework. Otherwise, they won't trust the technology if it's not compliant. So we favor emerging regulations in many jurisdictions to embrace DLT technology across the board for many asset classes. And that helped us in a way, because we built our platform with always compliance in mind, with rules and regulation and specific rules governing security issuances. So we built a whole system of tokens as well as on-chain identity in order to represent either personal investors or financial institutions, and assign to them clear rules and attributes in order to transfer security tokens. So driver really for growth is regulation, because people trust it and they believe the tech and they know that it's abiding by the domestic obligation.
Yeah. Sorry, I just want to add to that. I think, particularly in blockchain, this is something that's been talked about a lot, is just the need for legal and regulatory certainty, and particularly for large institutions, that's really critical for us. So when a regulator hasn't commented on an area or is still investigating an area, it's naturally not going to be something that existing financial institutions go after, because it's just too risky if you don't know what's going to happen. So the fact that we do now have much more clarity from regulators on some of these areas, as Damien says, I think that's a huge enabler.
Yeah, and especially when some regulators say that they're agnostic about the technology, and what they look at are regulated entity, function, operational processes that they issue regulations on. But practically, clients like when a specific regulation is being issued, because then they can leverage on that and convince internally stakeholders that technology is fit for purpose and it can be used effectively. Last June, the government of Monaco has issued a complete security token issuance framework and has selected Tokeny as sole tokenization provider for issuance out of Monaco. So that brings us some lots of confidence and potential investors and issuers in order to use security tokens. So I echo Charlotte's point of view. Regulation credibilize the tech and enable investors and issuers to play with it.
And maybe just to add to this one, what I think it is related to, I think FinTech these days, it's becoming more about collaboration and partnering rather than competition, right? And we clearly see that on the regulatory side, right? Me speaking as a lawyer, we see a number of initiatives by the governments, different countries, sandboxes being the best example, but it's not only the sandbox, right? The regulators, I guess, are coming to realize that technology is the future. It's what's gonna be like for in the next years, and are much more willing and open to engage with FinTechs. Is that in line with your experience? Is that what you think?
Absolutely, and there is a huge demand from regulator, professional bodies, market authorities in order to learn about the tech, to understand what the challenges are, to see what regulatory changes should be made in order for the tech to flourish, to understand all the market players, to get feedback about the tech they are using, because no nation wants to be left behind when it comes to technology. So even though they all abide by the same principles about market integrity, protecting investors, ensuring a level playing field, every nation wants to embrace technology and develop growth, and there is a kind of collaboration, but at the same time emulation between regulatory bodies within Europe and globally more generally.
I think regulation also supports, it drives blockchain, but it also drives specific business models in AI, because banking is so heavily regulated, especially on the data side and data sharing side. We won't see a future anytime soon where banks upload millions of their documents into Google Cloud, and then NLP will analyze that for them, right? So I think that strict privacy and data protection means business models like ours, where you work with constrained or smaller document samples, suddenly become more powerful. So this is the flip side of it.
Thank you. Let's go back to the questions from the audience. What are the biggest obstacles to mutualizing operational costs through industry consortia? It's an interesting one. Daniel, that's one. This one, you're the lucky one.
Someone else could take that. I have no answer to that. Someone else can answer that, because I'm not working with any industry consortia.
Anyone?
I mean, I guess to some degree we are, because it's a SaaS, and we help our customers achieve economies of scale by using us as one of many customers. So therefore, it's there's definite benefits in terms of biggest obstacles. It's just maybe in-house ones, which again I might have to throw to Charlotte, because she's working for the larger firm.
Yeah, I'd say industry consortia is something that we potentially maybe see more on the sell side than we do on the buy side. We're often quite led by sell side innovation. So yeah, in terms of mutualizing a cost, I guess, depending on how experimental it is, that cost benefit isn't always that clear up front. So, creating the kind of business case for that collaboration, how that should be shared, and then also kind of how the benefits should be shared, can be challenging. But again, it's not something that we generally participate in to a huge degree, I would say, those big industry consortia projects.
Thank you. I'm conscious of the time. We only have 5 minutes left. So maybe just one question, and this will be a question for a volunteer. In terms of how we how we view the current state of capital markets focused fintechs in Europe compared to US, right? And of course, it goes to the question that we've been hearing quite a lot. Are those markets developing at different speeds? Are we talking about economies of scale, the US being a much bigger country? How do you view this? If you want to throw in Asia as another region, by all means, feel free to do so. But how do you view the current state of affairs in Europe compared to other regions?
So I guess if I were to take this, I think this is something you talk about a lot in FinTech more generally, and how different the US, European, Asian markets are, both in terms of obviously the funding available in North America is really, really significant compared with some other regions, although it is accelerating in Europe. I think that's something that's true in kind of financial services generally, where you get a lot of cross-border payments tech in Europe, and you get a lot of thinking about personal finance and credit, for example, in the States. But I think capital markets is a really global ecosystem, and I think it's harder to separate out into just purely a regional focus. That said, I think the UK has a great opportunity to be a real leader in capital markets innovation. We've got a really forward-thinking regulator that's happy to work with both startups and the incumbents, and there's plenty of investment. I guess from a regulatory perspective, I maybe haven't seen quite as much proactive support in the States, which is quite surprising given that they've got a lot of really great innovation in tech, and obviously New York is a very mature capital markets ecosystem, but from a regulatory perspective, maybe potentially not quite so much participation. I think also, to go back to Damien's point, countries want to set themselves up as leaders in these different areas, and I think for the UK, fintech's a really important part of our economy, and nobody wants to get left behind. I think talking about Europe, we should probably mention Switzerland, particularly from the blockchain perspective. They've really set themselves up as a leader, and with the planned launches of SDX and then Archax in the UK, and there's activity in Singapore. I just think it's a very global, it's very global approach that's quite difficult to purely talk about on a regional basis.
Thank you. We have 2 minutes left for our panel, so why don't we conclude by me asking you to give us a 30-second prediction for the next 12 and 18 months, what you are expecting to happen to your business, to the market more generally. Damien.
I would say that digitization will remain at the top of the agenda for corporates and FIs in the months to come. Increase operational efficiency, increase distribution, and tokenization will be, of course, a key element of these trends for the upcoming years. That's a given for us.
I mean, I can say that the only constant we have is change. This past year has certainly taught us that, isn't it? But it certainly seems to be, well, I can say that we're certainly on the march. So I expect us to be growing faster and faster. And let's hope that this summer is going to be a rather good one from a business and personal perspective, where we all can stretch our legs again. So I think that's what's coming.
So I think from our point of view, I think I wouldn't even describe last year as a roller coaster. I think that's not even hitting the nail on the head. But I think that kind of market activity, the ups and downs, we will see more of that going forward. But for us as a business in Document AI, that's actually good because it really hammers home the need to understand documentation. Also, it means you still have to meet regulatory deadlines like the LIBOR review that you need to get done. And to get that done with all of this interference, the best way to do it is through technology. So I think that trend will just remain very strong over the next 12 to 18 months.
And yeah, from my point of view, I think I've already touched on ESG as a really big trend, so I won't repeat that. I think another one that I'm quite excited about is private assets and increasing access to the private markets. We've seen a lot of industry activity in that space, a lot of startups, a lot of M&A partnerships between incumbents and startups, and then of course kind of speaking to Damien's point, the concept of tokenizing private assets and then being able to trade those on digital exchanges, which is coming at who knows what time scale. So I think that's really interesting, and I think there's a lot to be done in private assets.
Excellent. It looks like we're all very optimistic. And so on that very positive note, thank you very much again for your time. Thank you for joining us, and thank you everyone for listening. Thank you, and have a good day.
Thanks.
An absolute pleasure. Thanks very much.
Thank you very much.